This is Nightly Business Report with Bill Griffith and Sue Herrera.
Stocks rocket higher. The market rallies as hiring surges, suggesting that the economy may be healthier than some had thought.
There is no preset path for policy.
The Fed chair pledges patience when it comes to interest rate increases, marking a shift in tone which eased concerns among investors. Meet and greet. Overhauling customer service is no easy task, but one entrepreneur found a way and turned his bright idea into a growing business. Those stories and much more tonight on Nightly Business Report for this Friday, January the 4th. And we do bid you a good evening, everybody, and welcome. Sue is off tonight, but the center of the action today and all week was again right here at the New York Stock Exchange. Stocks rallied big time after a string of good news on the job market, on interest rates, and possibly on trade as well. That combination created intense buying, offsetting the intense selling that we saw yesterday. And by the close of trade today, the Dow was up 746 points, back above 23,000. The NASDAQ was the big winner today, adding 275 points, or more than 4%, while the S&P was up 84. And in fact, the broad rally sent the small cap Russell 2000 index up by more than 3.5%. But let's begin tonight with jobs. Employers added a lot more of them than expected last month. As it turns out, 2018 was the best for job growth since 2015, and wages posted one of their biggest annual increases in a decade. As Ylan Mui reports now, the labor market is showing its strength in different ways.
Zach Mahler is unemployed, but he's not stressed about it.
The economy's been nice and strong, and I feel like for someone here in DC, someone with a graduate degree, like there are a lot of options available.
Mahler quit his job 3 weeks ago. He's got a new job lined up, but he didn't want to start right away. That makes him what the Labor Department calls a job leaver, someone who voluntarily ends their employment to try something new. Roughly 840,000 workers fell into that category in December. That's a big jump from the previous month, and it helped drive the unemployment rate up from 3.7 to 3.9%, even though companies were hiring like crazy. The economy added a whopping 312,000 jobs in December, almost twice what analysts had expected. Business owners like Barbara Martin, who runs a marketing firm, say they're desperate to fill positions.
We're doing a lot more job postings across a lot of different websites than we have in the past. We are now engaged with a couple of recruiters for some of these key positions. We are posting these jobs a lot on our social media, and we are just doing a lot of glad handing out there in the market and just meeting lots of people.
Job gains were strong across almost every sector of the economy. Manufacturing added 32,000 workers. Restaurants and bars were up 41,000 jobs, and it was a record month for the healthcare industry. It gained 50,000 jobs, the most since the government began tracking that data. Wages were also up. Average hourly earnings rose 11 cents, or 3.2% over last year. Call it a job seeker's dream. Mahler is making the most of his time off.
It was a nice time to just kind of reset, refresh, and kind of start a new job, like ready to, go in there and like crush it from day one.
On Monday, he starts his brand new job. For Nightly Business Report, I'm Ylan Mui in Washington.
And Fed Chair Jerome Powell also boosted investor enthusiasm for stocks today when he said that the central bank is not necessarily on a fixed path to push interest rates higher. Steve Leisman has more on that tonight from Atlanta.
A super strong jobs report would normally raise fears of more interest rate hikes from the Federal Reserve, but not with today's report of 312,000 jobs created in December. The reason? A dovish-sounding Fed Chairman Jerome Powell telling markets what they wanted to hear. He's flexible and not hell-bent on raising interest rates.
We will be prepared to adjust policy quickly and flexibly, and to use all of our tools to support the economy, should that be appropriate, to keep the expansion on track, to keep the labor market strong and to keep inflation near 2%.
Speaking at the American Economic Association annual meeting in Atlanta, flanked by two former Fed leaders, Powell tried to counter critics who have contended the Fed was not attentive to the gyrations in markets and to their fears of slower growth this year.
Markets are expressing concerns, again, about global growth in particular. I think that's becoming the main focus, and trade negotiations, which are related to that. And I'll just say that we're listening carefully to that. We're listening with, sensitively to the message that markets are sending, and we're going to be taking those downside risks into account as we make policy going forward.
In the biggest change, Powell said the Fed's plans to wind down its balance sheet, which was boosted during the financial crisis to keep interest rates low, also can be changed. The question markets now have to ponder, is Powell just telling them what they want to hear? Or has he truly become more dovish? If the data don't confirm the sharp slowdown that markets now fear, the Fed could be right back to talking about more rate hikes later this year. For Nightly Business Report, I'm Steve Leisman in Atlanta.
Well, let's talk more about the economy, jobs, and the markets. Joining us tonight, Brian Levitt. He's the senior investment strategist at Oppenheimer Funds. Welcome to the New York Stock Exchange.
Thank you. Good to be here.
Two big pluses for the markets today. You had a big jobs report and a dovish Fed chairman.
Yes, that's right. And the first thing is the jobs report is proof that this is not an economy that's heading into a recession. These concerns about U.S. slowdown were way overstated. Yeah, the economy's slowing. We pumped a lot of stimulus in. Rates go up. The economy slows. But this was not a collapsing environment.
So what has the stock market been telling us then with the big declines we've seen in October, November, and December?
So what the stock market's been telling us is that it was concerned about how financial conditions have tightened so significantly. That was on higher rates and higher prospects for further rate hikes from the Fed, a stronger dollar, credit spreads blowing out a bit. That was tightening financial conditions and weighing on sentiment. That's why it was so important for the Fed to back off.
But if we continue with this kind of job growth, I mean, even November and October were revised higher in terms of job growth. So the average job growth was about 254,000 per month, which, as we said, is the strongest in 3 years. That sounds like the Fed would need to continue to raise rates.
Well, look, it's the first time in a while that we've been above 3% on wage growth for a bit of a sustainable period. And so to try and kill that now with a series of interest rate hikes seems ill-timed. So the market right now is saying, well, the Fed, given Powell's talk about flexibility, is more likely to back off. If this economy continues to remain strong, long rates will go up and the Fed will be able to slowly raise interest rates. But it's going to be data dependent. The Fed's going to be flexible. In my opinion, this economy will likely slow through 2019, primarily because a lot of that stimulus starts to fade. And so as we slow, I think it's appropriate for the Fed to not raise rates.
And the trade dispute as well. I mean, we know the Chinese economy is slowing down, and it doesn't help that we have the tariff tiff going on right now.
It doesn't help. I mean, look, what ultimately ends a cycle is a policy mistake. And from our perspective, given that inflation is generally benign, this cycle could go on far longer than most investors currently expect, unless we have a policy mistake. So step one, Powell seemingly backing off today. Step two, we need to have some clarity on this trade spat. Hopefully that would moderate the dollar, ease financial conditions, stabilize Chinese growth, and that creates a nice backdrop for equities.
So before you go then, what are your expectations for stocks this year?
I actually think 2019 is going to be a very good year for stocks globally, not only in the United States. Last year was a year in which we had really good growth but bad policy. This is going to be a year, in our view, that's going to be more modest growth but better policy. And paradoxically, that's actually better for equities. Stocks are now as cheap to bonds as they've been since 2016, and before that, 2013.
Well, we certainly got off to a good start for this week,
We did.
Brian Levitt with Oppenheimer Funds, thanks for joining us.
Thanks a lot.
I appreciate it. Investors were also encouraged by a small piece of news on trade, which, as we've discussed, is an issue that's been dogging the markets for months. China today did confirm a two-day meeting with U.S. representatives to try to resolve that dispute, and that meeting will take place this Monday and Tuesday. And that news probably helped Caterpillar and Boeing, two stocks that have become proxies for U.S.-China trade relations. They were both up more than 5% in today's session. Meantime, in Washington, Republicans, Democrats, and federal workers are bracing for what could be a lengthy shutdown after President Trump confirmed today that he told House leaders that the partial government closing could last for months, maybe years. He was asked about that by a reporter during an afternoon news conference.
You said in the meeting, this is him quoting you, I just want to check, that the shutdown could go on for months or even a year or longer. Did you say that? And is that your?
I did.
Is that your assessment of where we are?
That. Absolutely, I said that. I don't think it will, but I am prepared, and I think I can speak for Republicans in the House and Republicans in the Senate. They feel very strongly about having a safe country, having a border that makes sense.
A number of economists estimate that each week of the shutdown will reduce economic growth by about 0.1%, but that drag should mostly reverse itself when the government does fully reopen. Time to take a look at some of today's upgrades and downgrades. We begin with Dow component Intel, which was upgraded to buy from neutral at Bank of America Merrill Lynch. The analyst there cites its exposure to fast-growing industries, including cloud computing, artificial intelligence, and 5G wireless networks. Price target now $60. Shares rose by 6% today to $47.22. Fellow Dow component United Technologies was downgraded to sector perform from outperform at RBC Capital Markets. The analyst says that the stock may be stuck in limbo until the company's previously announced breakup, which occurs in 2020. Price target $119, and shares gained more than 3% today to $107.02. Netflix was added to the conviction buy list at Goldman Sachs. The analyst says that Netflix investment in content, technology, and distribution will drive subscriber growth above expectations. Those are high expectations, too. Price target $400 now. Shares added more than 9.5% today to $297.57. Still ahead, with the labor market hot and wages rising, is it time to invest in the American consumer? Our market monitor says yes. But first, a look at the weekly gains for the major averages. And it is time for our weekly market monitor, who is betting on continued growth in e-commerce in the new year. He has names that he says you'll want to own for the next 3 to 5 years. This is his first time on Nightly Business Report. We welcome Dryden Pence. He's Chief Investment Officer at the Pence Wealth Management. Good to see you, Dryden. Thanks for joining us tonight.
Good to see you, Bill. Thanks for having me on.
You bet. And let's start with your first pick, which is Apple. Very much in the news, caused the big sell-off yesterday. They see a slowdown in iPhone sales, especially in China, and the stock has just been tanking since October. You like it. Why?
Well, we like it, particularly at these levels. We like it because I think people underestimate a couple things. Obviously, it's a China story, but that's China only, and trade wars in, trade drifts in, and I think that we'll see a rapid recovery from that. But what we really like about Apple is how it has changed and is changing. It's increased its service-style business, $37 billion. That's bigger than, that's the revenues. It's bigger than Netflix and Adobe combined and Salesforce combined. And then you also have to recognize the value of their cash. If you just took the interest earned on the cash that Apple has, that's equivalent to the sales of, they'd be the 153rd largest company in the S&P, just on the cash they're holding alone. So they have these two big things that make them very strong. All
right. Now let's go to Amazon. Of course, when you think of e-commerce, Amazon is the clear leader there, but it has also suffered recently. I guess, do you like it more now because it has come down a bit?
Absolutely. Roughly 50% of all of the e-commerce trade or searches start on Amazon one way or the other. We had a huge Christmas season. Online shopping is the most fastest growing part of retail commerce, and Amazon clearly dominates that. And we think for the longest of time, as consumers, more people making more money than ever before, consumers are going to spend more money on e-commerce, and Amazon is going to get the lion's share of that activity.
And finally, Visa, and I'm curious about this one because this is a very competitive business if you're talking about electronic payments. There are a lot of companies out there, including Apple Pay and PayPal and others, that are competing with the likes of Visa to be a part of this industry. Why do you like this one in particular?
they're absolutely dominant. They have 60% of the U.S. market and the market in Europe. And you really can't do an online trade without using Visa or MasterCard or PayPal, one of those. And they're absolutely dominant in that space. So we think that as more people buy online, they're going to continue to use Apple, use Amazon, use Visa or companies similar to that. You just can't do a transaction without it.
Well, you're definitely going with the brand names in those categories, that's for sure. Dryden Pence with the Pence Wealth Management. Good to see you. Thanks for joining us tonight.
Thank you very much, Bill. Appreciate being here.
You bet. And to read more about his picks, you can head to our website at nbr.com. In the meantime, Qualcomm was in court today. The semiconductor company whose products power cellular connections of smartphones and tablets worldwide is in a crucial battle with the Federal Trade Commission right now. Qualcomm is accused of having a monopoly on its mobile chip technology. And as Josh Lipton reports, the stakes are very high.
It's a case that strikes at the heart of Qualcomm's business model. Lawyers for the U.S. Federal Trade Commission said in court today that the company maintains a monopoly over a key type of chip used in cell phones by using anti-competitive tactics. They say that Qualcomm only supplies these chips to cell phone manufacturers if those manufacturers also agree to license patents from Qualcomm on its preferred terms. Regulators argue that forces companies to pay too much for those patents. Analysts say that the FTC is taking direct aim here at Qualcomm's bread and butter, its patent licensing business.
The risk to Qualcomm's business is that essentially 50% of their revenue is based on intellectual property or patents. And if the government steps in and mandates a lower price, Qualcomm's revenue and profitability would be offset by the difference between the market price and the government set price.
For its part, Qualcomm denies any and all wrongdoing, countering that the government hasn't proven that consumers or the broader competitive market have been harmed by its business practices, saying the complaint is based on a flawed legal theory, a lack of economic support, and significant misconceptions about the mobile technology industry. But it's not just the FTC. Qualcomm has had to defend its business model in a number of high-profile regulatory and legal challenges around the world, including a fight right now with one of its big customers, Apple, which is also upset with Qualcomm's licensing fees. That trial is scheduled to start in April. One former FTC chair says the agency, though, has set an ambitious goal for itself with this case, that U.S. antitrust law is generally sympathetic to dominant companies setting prices for the products they create. For Nightly Business Report, I'm Josh Lipton, San Jose, California.
GameStop may be closing in on a buyout deal, and that's where we begin tonight's market focus. Two private equity firms are reportedly bidding for the video game and electronics retailer, and according to the Wall Street Journal, a deal could be announced sometime around mid-February, and shares advanced 17.5% today on that news, closing the day at $15.24. Marriott now says fewer customer records were stolen in a massive cyber attack than initially estimated. The attack was disclosed last month, and at the time it was believed that 500 million people were affected, but that estimate has now been lowered to 383 million guests. Shares gained nearly 6% today to 107.81. Cal-Maine's profit beat expectations, but revenue missed estimates because of a decline in eggs sold. The egg producer did, however, say that specialty eggs are becoming a bigger part of its business as consumers pay up for cage-free or organic products. And the stock rose more than 3% today to $43.58. Private equity firm Apollo Global Management is reportedly considering a bid for General Electric's aircraft leasing unit. That unit is said to be worth about $40 billion. GE stock rose in initial after-hours trading tonight. It closed the regular session at $8.23. Well, it was a strong holiday season marked by the strongest consumer spending in years. But all that shopping also translates into a lot of returns. And that means big demand for warehouse space, especially with the growth of e-commerce. Diana Olick explains.
As plentiful as the gifts were delivered to our doorsteps, close to $100 billion worth of them will be returned, and most will end up in warehouses like this one in Nashville.
What's going on behind me is the hangover from the buying season during the holidays when reverse logistics kicks in.
Reverse logistics is a fancy term for dealing with all those returns. While store shoppers return about 8% of what they buy, online shoppers send back close to 30%. And most of those items have to be brought to warehouses, checked for damage, repackaged, and either sent back to retailers, liquidators, or often just thrown away. Reverse logistics is now the #1 new user of warehouse space in the U.S., according to CBRE, taking up 700 million square feet nationally.
Demand for the space is only going to increase in warehouses unless and until we find a better solution to either return to the store or better incentives for consumers not to return the goods.
That demand boosts the bottom line of warehouse REITs like Prologis, East Group Properties, and Stag Industrial, as well as logistics companies like XPO Logistics, which both owns or leases warehouse space.
Warehouse REITs have been a hot sector since 2012 with the surge in e-commerce, and demand has generally outpaced supply despite a lot of new construction. There was concern that the trade war might hurt demand, but so far economic growth has offset those fears, and one of the strongest holiday retail season in years only confirmed that.
I don't think we're past the peak yet, though we had suggested earlier that we might have seen that. We didn't.
Because the more goods we have sent to us, the more we will inevitably send back. For Nightly Business Report, I'm Diana Olick in Washington.
The business community tonight is mourning the passing of a titan in the airline industry, and he was a real character too. Herb Kelleher, the founder of Southwest Air, will be remembered as the original disruptor of the airline industry. He revolutionized low-cost air travel, got rid of assigned seating, and in the process democratized the skies. He was also known for his whimsical sense of humor, which became part of Southwest's reputation. Mr. Kelleher grew Southwest from a small regional airline to a much larger domestic air carrier. Cause of death was not disclosed. Herb Kelleher was 87 years old. More and more, your first interaction with a business is often through its website. And when you have a specific question, the answer usually occurs during a live electronic chat. But live chats can sometimes be stilted and awkward. And that's why one entrepreneur in Lee's Summit, Missouri, came up with the bright idea to make chat a more personal, more intelligent exchange of information. That is the sound of chat. 85 chat specialists based outside Kansas City, Missouri, working for 1,400 companies. Scott Hansen got the idea while managing his mother's orthodontic practice.
We were looking for ways that we could get to patients sooner in the buying process. The reality is, before you have a customer in the office, online is what all of your new customers experience about you.
But how? Hire someone? Too expensive. Outsource it? Less than optimal.
Felt very robotic. The businesses providing those services are largely outsourced overseas, and they just provide a different level of service. They're not categorically bad, and for us, those conversations were very high stakes.
Each patient can mean thousands of dollars for an orthodontic practice.
We would love to talk with Bobby a little bit further.
It should be as if you were walking into an office or calling someone over the phone.
When Hansen offered to share costs with other orthodontists, several bit. And suddenly, in January of 2016, Hansen had a new and growing business, Professional Chats.
How's everybody doing today?
A business school friend, Trevor Flanagan, joined Hansen to help manage the company's rapid growth. Dentists, chiropractors, and home service providers like plumbers were signing up. Some pay hundreds of dollars a month, others thousands, depending on the number of chats. 2 years in, Flanagan says they're adding 100 clients a month. Their chat specialists, working for 3 clients per shift, deal with medical issues, home repairs, and sometimes job applicants.
And they are looking for a job as an administrative assistant.
Rather than take on all comers, ProChats operates in just 8 industries for now, sectors Flanagan and Hansen want to own when it comes to chat.
I think owning a silo is the way to go. We service like 1 out of every 10 orthodontists now.
Specialists get regular training updates, and there's always help nearby.
Exactly. So she's having about 3 conversations at once.
On the right side of the screen, a conversation guide. Each group also has a coach who can whisper into a conversation.
The customer doesn't see it, but our chat specialist does.
It's a delicate dance, building relationships with prospective customers while hooking sales leads for their clients.
If we get first name, last name, phone number, email, physical address, they're very much more likely to only use that customer, and that's what we want.
Does it work? Scott Horstman, who owns a Kansas City roofing business, is a ProChats customer and a believer.
Every touch with a customer is telling that customer who you are and what you're about. And if they come with the same values, beliefs, principles, integrity that we do, when they hand that off to us, it's a natural flow for the customer.
In the end, it's just chat. But for Flanagan and Hansen, it's a conversation worth having.
It is really cool to look around and see what we've built and how it's impacting the 100+ people here, but thousands of customers, and that's really satisfying.
Hansen does like to quote studies that show that when chat is used in the right way by the right types of companies, it can drive up to a 40% jump in sales leads generated by the company's website. That is Nightly Business Report for tonight. I'm Bill Griffith. Thanks so much for joining us. Sue's back with me on Monday. In the meantime, have a great weekend. See you then.